Interest rates have jumped up significantly this year. They've more than doubled, which has put many of you on the fence about buying a house. Many of you quit altogether simply because rising interest rates caused your buying power to drop, and then essentially it took you out of the market. But I wanted to give you a few strategies and tips to think about how to navigate a market with higher interest rates. If we haven't met before, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your homes all across the country. Whether you're a first-time home buyer or a seasoned investor, I've been doing loans for over 15 years, and I run one of the top teams in the entire country. And I'm here to simplify home ownership so you can enjoy the process and enjoy being a homeowner. And if you have questions on your specific scenario, you can always send me an email and I'd be happy to do a no-cost analysis to help you out. Now, with rising interest rates, many buyers got scared. They've never seen a 7 before. They freaked out and they essentially quit the home buying process altogether. But it was sad to see because 7%, yes, even though it's higher than what we were accustomed to the last 2 years, but you have to take into account where we were. Over the last 50 years, we've never seen interest rates in the 2% range. So we honestly got spoiled. And the fact that we had that nearly for the entire year, it created a storm that no one saw coming because interest rates got everybody refinancing and it got every buyer out there willing to pay top dollar for homes, even above what they were worth. Homes were flying off the shelves and everyone made a ton of money. And honestly, buyers got, for the most part, the deal of a lifetime. But let's think about today. So the first thing you need to do is you need to ignore what happened in the last 2 years, because that literally was something that I don't personally think we will see ever again. I don't think we will see rates in the 2s. Could we see things maybe in the 3s and 4s again? I definitely think we could maybe see that at some point, but you have to look at the now. You have to look at today. How do we be successful in today's market? Because if you're on the sidelines and you're waiting, thinking that I'm going to buy when rates come down to 2% again, you might be waiting another 50 or so years for that to happen. I've got 7 strategies to help you navigate the higher interest rate market that we're in right now. And the number one thing you want to do is make sure that you hire a good loan officer. This might sound obvious to you, but it's very important because so many people got into the mortgage business in the last few years. People that have no real estate experience, they probably don't even own their own house, got into the mortgage business and they're telling you what you need to do to go buy your first property. They have no experience and they're probably working in a cubicle and they have no idea what you're looking to do, what your goals are. So the number one thing that you want to do is interview and find a reputable lender. Work with someone who has experience and work with someone who's been through a few down markets before, because they will understand how to best structure your loan and they're going to have the knowledge to get you through the process. If all you care about is the lowest interest rate, remember, that takes absolutely no skill. That takes no skill whatsoever because all a lender needs to do is charge you more money to do that. So you want to work with somebody that's going to look at the right strategy and the best option for you. So number one, make sure to find the right lender. And the second thing, what you want to do is find the right real estate agent. Again, this might sound obvious, but same reasoning. A lot of realtors got in the game the last couple of years because the money was so easy. You listed a house today, you got 30 offers and half of them were willing to pay cash above the asking price. So they did no work and they were making $10,000+ per deal. Imagine that. You probably spent more time driving to the listing appointment and back to your office than what it took to sell the house. That's how much money was being made in the industry. But that doesn't necessarily mean that that realtor is good at their job. You want to look at someone who's been through these markets, who knows how to negotiate, because if they don't know how to negotiate, you will lose as a buyer in today's market. There's a lot of things to consider because if you're thinking about buying in your market and you anticipate another 5 or 10% pullback on prices, you might want to factor that into your purchase today. But if your realtor doesn't know how to negotiate, if your realtor doesn't know how to understand data and future forecast some of this information to you, you might lose. So finding the right real estate agent who knows how to negotiate, who knows how to read data, who knows how to get your deal done is really, really important in my opinion. But here's the cool thing. Finding a good realtor and lender usually go hand in hand. So if you talk to a good lender, they will most likely work with some of the top agents in their town. And if you work with a really good realtor first, they will probably refer you to a really good loan officer as well. So that may at least help you sift through a lot of the noise and a lot of the BS that's out there, and you'll find good people to represent you. Strategy number 3, be ready to pay points or buy your interest rate down. This is something that has become way more common these days simply because rates jumped up during the summertime. We went from the low 3s to 7% overnight. It's literally like someone flipped a switch. We came into the office the next day and rates were 7.5%. Now, many people freaked out when they saw this happen, but this was no different than when I first got into the business. In fact, my first house that I bought was a 7% interest rate, and the company I worked at did the loan for me, so I definitely got a deal, and that was the best that I could get. There was no better than that. However, 7% back in the day was the norm. So again, this is why I say you got to get rid of that mindset of waiting for 2 or 3% because that's not what we're dealing with today. It's like you're still hung up on your ex from 10 years ago and you're trying to date someone new. You have to get rid of that. It's not in your present anymore, so let it go. But in today's market, with the way that the market has shifted, and this is why I say you need to have a good real estate agent because they can negotiate with the seller to get them to cover these costs to buy your interest rate down. So there's a few ways that you can do that. Whether you're doing a permanent buy down, which is typically what most people were looking at, or you can look at a temporary buy down, which became a lot more prevalent because of how the program works. So let's just say today the interest rate is 7%. If you were on a 2-1 buy down, year 1 of your mortgage, you would have a 5% interest rate. So that represents the 2 because you have a 2% interest rate reduction for that entire year. Year 2, your interest rate would go to 6%. And then year 3, you'd be at 7% for the remainder of the loan. Now, that's a really good program because so many people out there are predicting that interest rates are going to come down. Now, we're shooting this video in December, and we have seen the CPI number get better in November and slightly better in December. So inflation is starting to come down, which means mortgage rates will soon follow. So this whole thought process of a temporary buy down is to take a below market interest rate for the first 24 months. Hopefully in that time frame, you have the value to be able to refinance into a lower interest rate going forward. Now, there was a bunch of memes and a lot of people talking about this, date the rate, marry the house. But the one thing they forgot to mention was that when you refinance, you have to have the right loan to value. And what I mean by that is what you owe on your house comparative to what the value of the home is. So if your loan to value is too high, you may not be able to refinance. So this is where, again, having a good realtor will negotiate any sort of pullbacks into the market. You can negotiate that up front. Let's just say you're buying a $400,000 house, but you think the market might come down another 5 or so percent. So instead of giving them $400,000, offer them $380, offer them $375. I've done videos showing the comparison of homes where they recently reduced over $20,000+ on a $400,000 house. It's doable. It's out there. But you have to be willing to ask. Number 4, consider an adjustable rate mortgage. This got a lot of flack because of what happened during the 2008 crash. However, it is another way to go about dealing with higher interest rates. So typically on an adjustable rate mortgage, you get a lower teaser rate is what they call it for the first however many years before your loan starts to adjust. I don't see too many of our clients ever doing this because the spread between a fixed rate mortgage and an adjustable is not there. I don't personally see it from loans that we've done. However, if you are looking into the higher price range of homes, $1 million and up, you may want to look at an adjustable because typically those clients have more disposable income, they have more money, or maybe they have a business that they're selling, or they know they're getting a big windfall of income within the next several years. So they have the ability to pay the house off or pay the house down if they so choose to then refinance. So again, if you're, let's just say a 5-year adjustable rate mortgage, and let's say your teaser rate is 5%, you'd have a 5% interest rate for the first 5 years. And at the end of that 60-month period, your loan would adjust based on the terms of the ARM that you signed. So again, you want to know your terms, you want to know what margins and your index is tied to, because those are all things that will make your payments go up or down. But again, for the interim, you can get a lower payment, get yourself into a house, and then if you know you're either selling, maybe you're going to move to another part of the country, or again, maybe you're coming up with a ton of money that you just pay the house off, or maybe you sell it. So that is another way that you can go about offsetting the higher rates today. Number 5, you can look at a shorter term mortgage. Typically, people will look at a 15-year mortgage or even a 10-year mortgage because the shorter the term, you typically get a lower interest rate. Now, the downside to doing that is your mortgage payment is going to go up because instead of paying the house in 30 years, you're now paying it in 15. Even though you have a cheaper interest rate, your payment will go up. So depending on what you can qualify for, that may or may not be a good option for you. If you're a higher income earner, this may be a better option because you have that disposable income. But if your income isn't so high and your debt to income ratio is very, very tight for you to qualify, that may not be the best option. But again, that ties back to my initial point of having a good loan officer, because you want your loan officer to show you these options on how you can get into your house. And number 6, work on your credit. This is one of the first things that any lender is going to do. They're going to look at your credit score. So if you are at a marginal score, you might want to work on it, because if you can get your score up another maybe 10 points, that may help qualify you for a lower interest rate. This ties back to my initial point, working with a good lender, because any good loan officer is going to know where the price breaks are with credit scores. And if they can help tweak your scores, whether it's paying maybe some of your debt down or just doing some small tweaks, they can get you those extra points and help you get a lower credit score. So this is why, like I said, the lender relationship that you have is so important, because they can literally make or break your entire transaction just with the knowledge and experience that they might have. And number 7, you want to compare options and strategies. Many buyers today simply shop their lender based on their loan estimate, which is really what's your interest rate. I probably get asked that question every single day. But the thing that you really want to compare are the loan options and the strategy, because again, any loan officer out there can quote you a low interest rate. And honestly, once a loan officer knows that that's all you're doing to them, they're probably going to quote you something to try to just get you in the door. And they're going to pull some sort of bait and switch on you. Now, you might not like that, but to that loan officer, if they need that deal to go through, they're going to say anything and everything possible to get you in the door. And they're going to hope and pray that you just don't fire them in the 11th hour. However, this happens every single day, unfortunately, in our industry. And this is why so many buyers hate mortgage loan officers, because they think of us as used car salesmen. No offense to used car salesmen, but that's one thing I remember getting into the business in 2008. So many people just hated loan officers. They really just despised us because of what they essentially thought we did to the entire mortgage market. But there was a lot more at play than just that. Make sure you're comparing apples to apples. Don't just glance at your loan estimate and make your decision based on the interest rate. I actually had one of our viewers reach out to us on one of his refinances, and I found out that the lender that he was working with was charging him like $25,000 to get his interest rate where it was. That was insane. I could save this guy a ton of money, and I'm glad he reached out. So if you guys find yourself in that position where you're shopping around and you just want an honest estimate, send me an email, and I'd be happy to at least give you an idea of the value of the estimate that you're getting. And if you're getting an amazing deal, I'll be the first to tell you, you better take that deal and make sure you lock in that interest rate. So if you don't know where to start with your home buying journey, you can hit the description below. There's a link to my first time home buyer's guide. It's going to walk you through the entire process. But if you're ready to get started, send me an email. We can get your application going and help you with your home purchase. Thanks so much for watching, and I'll see you on the next one.